I know that our business is really affected by so many things. It's often easy for us to overcomplicate what's really important. And one of the things I think we can all agree in is that the cycles of various markets seem to affect our business as much as anything else. And election cycles, economic cycles, and of course housing cycles. And like I just mentioned, I was a broker in the 90s and 2000s, and I saw that, being a mortgage broker kind of came out of favor in 2008. And we should all know that that segment right now is growing and thriving. And, whether you're looking to grow your current business and build on what you have, whether you're considering the move from retail to broker or move from one lender to another, kind of understanding the market and its timing is crucial. And we all know that when pipelines are full, it's sure difficult for anybody in the sales to make a move. And when the buying season is in full force, getting realtors to attend or getting their attention, is hard. And today, when you're flush with business, it's really hard to look too far forward. And, understand that. But I think the election cycle definitely affects us all. And not just because of our Facebook feeds and those uncomfortable family gatherings, right? It affects the economy. And, but really it seems to affect our business more than most out there. And really this fintech disruption that's changing the way we all think about our business is on us. And we all know that we're somewhere in the beginning stages of this fintech disruption. And in a recent study by Fiserv, it was pointed out that borrowers last year were 35% more comfortable taking out a loan through a tech company than in 2017. And as you kind of look at additional cycles, the cyclical nature of home sales over the years have been something that we're all aware of. But in general, most of us don't focus on that big macro viewpoint of our business, right? So even though the cycles of our business affect us all, I think a lot of us can remember just as far as last year when the margin compression and how that affected us all. And, if you've been around long enough as I have, I remember the cycle of 98, the downturn in 2008. And now here we are, looking at I'm actually showing, and I don't know if you can see this, JC, but I'm showing a chart of interest rates from 1990 to today. And within that chart, I have the timing as to when you started these various companies. And you've invested and co-founded 5 companies since 1996. And so far, you've been able to sell 3 of those, and 2 of the others are essentially at the beginning of their cycle. And, another side note, Spring just turned 4 years this week. So congrats on that. And many of us with the entrepreneurial mindsets think about selling or having some type of exit strategy during our careers, but you've been able to do that successfully multiple times. And we all know that success leaves clues. So if you could please help us understand, what criteria did you use when entering these markets over the years? And can you share some insights with us regarding the timing of the cycles?
Okay, well, I'm going to assume that most on this call are in the financial services business. So,
yep.
Which is, cycles are determined by interest rates. But I also believe, there's never a bad time to start a good company. And whether you're in the business of starting companies, which I guess I've defaulted to, or you're running your own company, you gotta have a good feel for the short term so you can make money and survive day to day. But it's important to be able to have some idea how that fits into the long term, especially if you're building a company that you hope that someone will buy. And I think everybody aspires to that. So, and I think that's a good thing to aspire to. But when it comes to starting a company, I've got 4 criteria that I've distilled it down to that works for me. And everybody's different, and I'll just put a disclaimer out there. My criteria may not work for everybody, but it works for me. And in no particular order, and I give all the same weight. The first thing is there a change? Is there a change in the market that's inviting a new entrant? And an obvious one is when rates change. If as you enter into after a increased interest rate environment, that's always the easiest time to start an origination company, because when rates go up, 40 to 50% of the origination companies will exit the business until rates come back down again. So clearly it's less crowded. But when it comes to starting a company, oftentimes a more compelling reason can be, is there a shift in the market that existing companies haven't accommodated for? Or is there a shift in the market that gives everybody an equal footing at the beginning of that shift? So you've mentioned 5 companies I'm involved in, 3 that I'm no longer involved in, and 2 that are currently active. As we go down this criteria, I'll give you examples of the 2 companies I'm active in because it's more real time. So what shifted in the market that made me want to get involved with Spring EQ, and we're going to talk about a servicing company as well, ServiceMac. With Spring EQ, what the shift is that there's been a historically long and historically low interest rate environment, 2 distinctly different things in the same last 10 years. And what that's created is a historical amount of equity that's trapped in residential homes. So since the meltdown of '07, you had a remarkably smooth recovery over the last 10 years. And 2 things have happened. A tremendous amount of equity. 3 things, actually. A tremendous amount of equity that's in these homes. A large percentage of people who have taken advantage, actually most more than once, of the low interest rate environment we've had the last 10 years. So people right now are an unusually high amount of folks have probably the best mortgage they're going to have, and they have it right now. And then so with those 2 things, you've got an opportunity for the home equity business to make a resurgence. And with the advent of technology, it's gotten easier to do these home equity lines. So if you look at that, there is right now, like our business at Spring EQ, we've doubled it over the last 2 years. There's other people now getting interested. So because it's been the type of historical 10-run period that we've had, the home equity business has been dormant. There's probably some folks on this phone, if you've only been in lending 10 years, you wouldn't have known that the home equity business was a very large business prior to the last 10 years. And the reason for that is a typical rate cycle was anywhere from 4 to 6 years. And it was that way prior to 2001. It was that way for the previous 30, 40 years. And the reason it's changed is when 9/11 happened, a lot of people don't remember this, but rates had gone up 3 or 4 times in 2001 to end a 6-year low rate cycle. And after 2001, after the rates went up 4 times, rates were lowered 7 times that year in response to 9/11. That triggered, that stopped the cycle from going up and extended that low rate cycle. So that turned what was a 5-year cycle into a 12-year cycle. And now we have a subsequent 10, 11-year cycle behind that. So because of that, it's been dormant. But as we get into the 10th year of this particular cycle, and with an election coming up, I think everybody would agree that rates have nowhere to go but up. The question is when. They tried to do it a little bit last year, and then it stopped. And then with the election coming up, some are thinking that there's a good chance that that would be the time. So having said all that, the home equity, the market right now is right for the home equity sector to reopen. So again, when we talk about 4 criteria, I'm talking about there's got to be something in the market that makes it compelling, and that makes it compelling for us. Number 2, you have to start a company. You have to feel like you got to be convinced you got a world-class operator who's got a track record that can start a company from scratch and develop it, knowing the market conditions. And so with Spring EQ, you got Jerry Schiano, who is the CEO, and this is Jerry's third company. So Jerry was successful back when I had Decision One. He had WSFS, and he successfully built that, and it was sold to AIG. He became one of the top 10 lenders at the time, and a competitor of mine, a respected competitor of mine. And then he also he was the founder. I was the lead investor of ShellPoint, and we started that one when in 2007 and 8, when after the market meltdown. And again, good time to start a company. But he is at the helm, and you got to believe that you've got a world-class leader that can start a company. Third criteria is you got to have patient capital and the right amount of it. So the only thing I would say about that is patient is important so that it's designed to go longer than you think you need it. But more importantly, a rule of thumb I have is when you sit in a conference room and do your pro forma, and you give a conservative estimate of when you think you're going to break even and how much money that takes, what my belief is, whatever that number is, you need to raise or have access to twice that amount. And the reason for that is when you, in a conference room, you can't see everything out there. There could be a potential speed bump that will cost more money. Or can you see some potential opportunities once you get out there and start, where you need capital to maybe recruit an executive you didn't know you could get, or pick up a company at a discount that you didn't know you could get that could be an integral part of what you're doing. I'll give you the best example I know of this is with the servicing company, ServiceMac, that we started 2 years ago. What I didn't put on my list of risks was that the government would shut down for 2 months while I was trying to get licensed. So at the time that the government shut down, I had 70 employees, and it extended the licensing cycle by 2 years. I could have never, it was historical to not have projected that, but it cost a material amount of capital to do that. So patient capital and enough of it. And if you make a mistake on raising capital, it's better to raise too much than too little. It's much easier to give back capital than it is to raise it when you are falling short. Fourth criteria is, and this is a real important one for me, I wouldn't start a company without it, and that is you feel like you have to have an anchor tenant as a customer. One customer who is there to buy your product, is there to be your customer out of the gate, so that it helps you skip over the burning capital period or manage that period effectively. So 2 reasons: it helps you validate the capital you raise, and 2, it gives you a superstar client to point to when you do your sales presentations, all your other clients that you're trying to set up. So those 4 things just are the criteria that I look for when I start down this pathway. And then, John, you asked me to just make a comment about when's the right time to sell a company.
Yes, sir.
Yeah, this one is, there's a universal truth about selling a company, and it is the time to sell a company is when you are no longer 80% convinced that you can continue to make it more valuable. And that could be for a litany of reasons, but it could be market driven. It could be that you're at the end of your career. It could be that you're at the top of your capabilities. It could be that you're tired of doing something. So it's really important to know when you get to that point, there's no free ride when you're running your own company, and you can never coast. So if you're not growing it, you're shrinking it. And so when you get to that point, that's when it's time to really look at either selling all of it, or potentially selling a piece, part, or majority of it to a company that is larger with a bigger balance sheet that then will give you additional resources to continue to grow it. So but the one thing I would say there is when you're no longer convinced that you can add value to your company is when you really really need to plan to sell it. So if you look at the things I've been involved in, because it's interest rate sensitive, if you can time it, you want to sell towards the end of a low interest rate environment if that opportunity presents itself in this sandbox.
Gotcha. Well, I appreciate
so John,
that.
that's the best insight I can give you that I've learned over the last 25 years of doing this.
No, that's great insight, and also the last point there about time to sell the company. I appreciate that. Thank you very much.